Yo, welcome back, guys. And it'll be the only time I say it because it gets kind of old after a while. But Happy New Year. Happy 2026. Shout out to the chat. I see people in here giving it some love. So I appreciate everyone that's joining. Hope everyone had a good break, had some good time off. I know I did. I enjoy taking a little break every now and then. And it was nice. It was nice. Had a lot of cookies. Currently painting with my wife. We're painting some trim in our living room downstairs. So that's been taking a lot of time out of my day. But today it's all about what I got wrong in 2025. I think everyone's really excited for 2026. And this was the first day of trading in 2026. But I just wanted to take some time to reflect on 2025 and some of the lessons I learned. I think there's a lot of what we got right that's out there in the markets. But for me, this episode is going to be pretty personal, pretty selfish episode, just kind of reviewing what happened for me in 2025 and some of the lessons that I can look back on and learn from. So let's kind of get into it. Shout out to the chat. Shout out to Yako the Goat, Free, Brett, Judah. I see all you guys in here. I appreciate the love. So let's kind of get into it. So thing I want to start with today is just when you're in the business of investing, in the business of writing research, in the business of trading, it's really a mistake business, right? So in a book by Ned Davis called Being Right or Making Money, he has this quote: we're in the business of making mistakes. Winners make small mistakes, losers make big mistakes. So that's the first lesson for myself and for everyone in 2025 is like, you're going to make mistakes. That's a part of the business. It's a part of what we do. And don't be afraid to make mistakes. Just understand risk mitigation. Keeping those mistakes small is what's important and not letting them become big mistakes, because everyone's going to have down days, down weeks, even down years. Don't allow those to be too big of a hole where you can't get out of them, because that can be what happens. And honestly, that's why I got into technical analysis. I got into the markets 2017. Right, a lot of hot stocks, a lot of people feeling smart, and I rode some 60, 70% drawdowns. And I learned pretty quickly that big losses aren't great. So first chart I wanted to share here, I'm kind of going to start with micro, like a couple trades that I just got wrong. Right, and then I'll kind of go into some bigger themes in terms of 2025 that I got wrong. So first one, Duolingo. This one just sticks out to me because I was actually in Mexico when I wrote this post. I wrote a post about Duolingo, and it was a beautiful looking chart, right? You had this base breakout and you had a high and tight bull flag. And that's about all that was beautiful with Duolingo. And this is zooming out. This is just a cleaner version of that chart. It's the exact chart that I shared. Above 500, I liked this setup. I thought it was a good bullish continuation in a business that I thought had legs to it at the time. And let's see what it's done since, right? So Duolingo's down like a 70% drawdown from those highs. Literally, I basically top ticked this chart. And so what's funny about that is the fact that, 5 years ago, I'd probably be sitting in that drawdown still thinking, hey, it's on its way back. But when you have those high and tight flags, right, 500 was the level where you got out. So I literally haven't looked at this chart since then. And I pulled it up today because I just noticed I have a list of stocks I look at, and then I look at the drawdown and the positioning, right? And so my positioning, I had about a 6% loss in it, but now it's 70. So that's the first lesson for me, right, risk management using technicals is a beautiful tool because you don't sit in these 70% drawdowns. You'll hear stories of people really excited. I sat through that because I had conviction. I think one of the lessons I'll get into in a little bit is you can always get back in. So having stops that match, one, your trading style and the way you trade, but two, understanding that if you have a tight stop, right, you might have to get back in. If you have longer stops, you have more leeway to stay in the trade. But with these high and tight flags, when they fail, that's information for you to get out of the market. So we avoided a huge loss, but it was still something I got wrong this year. Duolingo was a chart I loved. I loved the looks of Duolingo, and it didn't pan out. The next one, this is a little more personal because I thought Deckers Outdoor Hoka, a company I've made a ton of money in, and I just thought it was going to continue. This was in January of this year. I thought this base breakout in Deck Outdoors was going to continue. I thought the Hoka acquisition was smart. And price was proving that to be correct. You had good relative strength, but that's all you had, right? This is the setup, deck outdoors, base breakout, around 214. Now we're sitting around $100 today. So 60% drawdown. And like I said, 5 years ago, this would have been something I sat in, but we had that really well-defined risk and against 200, right? Initial 210, but really getting out when we got back below 200, that round level. Once again, the lesson is I love Hoka product. I probably have 5, 6 pairs of shoes I've bought in the past 2 years from them. I thought the story was good. I thought the business made sense to me, but price is what pays. And so able to get out of something like this early and avoid a large drawdown is nice. Yes. Was I wrong? Yes. Did I have about an 8% loss in this? Yes. But I avoided the catastrophe that occurred afterwards by managing risk. So that's the first thing here is just, it's a mistakes business. You're going to have mistakes. Can you minimize those mistakes from becoming big mistakes? Because that's how you can continue to play the game. So those were just 2 trades. Those are 2 of my not largest losses, but 2 trades that then continue to be larger drawdowns. And so you'll hear a lot of people talk about, right, don't look at those trades again. I think one of the powers is if you get out and you see something then down 60, 70%, that's why you manage risk. So second thing I want to talk about today, and this lesson is a little more nuanced, is I had a call earlier in this year on bonds. So I wrote a post talking about bottom fishing and kind of my bottom fishing checklist, which is momentum divergence, failed breakdown in price, defined risk reward, which we had. We had this exact setup in bonds, right? You had the failed breakdown, the momentum divergence, and then we did have some follow through, right? So I was right on the surface of the trade. The problem is how I positioned myself for this trade was not a good positioning, because what I did is I used a short-term tactical trade to take a long-term position. So what did I do here? I bought, let's get a cleaner chart here. So as you guys can see, bonds did nothing, right? They worked for a little bit. I made a little money quickly, and then they failed again. So this is where bonds are sitting as of today. So basically nothing. So I was right for a little bit. For about several months, it looked like a great trade. The problem was I used a tactical bullish setup to inform a long-term trend position when the long-term trend in this was not up. So what I did is I bought $90 December calls. I believe that was the trade I took, $90 December calls, and they looked great. But I held them and held them and held them and held them, and then when the time came, they essentially expired worthless. So full loss on a trade like this when initially I was right. So what was the lesson here is my time frame alignment was wrong. I had a short-term tactical trade that worked, but I positioned for it long-term in December, right? This trade took place in June. I gave myself 6 months on something that was a tactical trade. Why would I do that? Right? That's just a lesson for myself is, I thought I could align. At least put on some tactical positioning, or at least the lesson is like, at least when I took that trade, I know there's hindsight bias to this, but I only did enough to where it was one position. I should have probably put on a couple more calls and closed half a position when they started to do really well, because this position was up 100% at one point, and I just kept letting it ride. So the lesson there is twofold. One, align your time frame. When you're looking at this shorter time frame, don't then take a long-term trade in it, because I actually had this be a larger position for a large portion of the year when I could have potentially taken a trade out a little bit sooner. So that's something for me to learn from, because you can always get back in the trade, right? And that's just something I had to learn this year and continue to learn, is that you can get back in a trade, because there's an interesting thing that happens as you continue to learn in the market is you can become confident, which everyone says you don't want to have an ego, but you also want to have confidence in what you're doing, because if you have confidence in what you're doing, you realize that, hey, I can be wrong, but there's going to be another trade. If you don't have confidence, a lot of times you'll swing the bat too far, or you'll hold on to something too much because you think this is going to be the trade. And I did that with bonds this year. It was the trade to me, and it failed. I failed at it, right? So That's something I have to learn from. So you can always get back in and position your time frame correctly. The last lesson with this one, because there's a lot of lessons for me from the bond trade, is I was trying to be too smart for the market. I think there's a lot of people that follow my work and a lot of people that are fans of mine and that I trust and colleagues that I love. And I think when you have that and you've done well in school and you've done well professionally, you can try to be unique in what you do. And that's the cost of being a contrarian sometimes, is you try to be too contrarian or too unique to a position. And I just wrote down in my notes, like, keep it simple. Like I've lost more money trying to be unique than I've made. And so the reason I say this is I've written a lot about how I thought the energy trade was stupid. And I was right about that last year. But guess what? Energies trade pretty well in line with yields, which I've shared this chart before. You guys have seen this work I've shared. But for some reason, I thought bonds were going to start a long-term trend reversal. Like I said, December, I thought they were going to be up, but energy was going to stay in its range. Why would I have had that review? The reason I had that view is because I was trying to be unique and I was trying to be different than other people. So that's the other lesson in this for me this year. Was what I got wrong was trying to be too unique and trying to force a trade that was a longer term trade where I didn't need to, for the sake of being unique, for the sake of being different. And that can happen a lot of times, right? You hear someone talk about, hey, this software name looks good. And people are like, I don't want to trade that software name. Let me find another software name. And so I think that's a lesson for me here too, is just like, keep it simple and stop trying to be overly unique sometimes. So next thing I wanted to talk about, this one is a little bit, once again, a little more nuanced, but I put a lot of thought and time into home builders and home construction throughout the year. And so it was a concern of mine, and it led me to, I was positioned, right? I had a positive year in the market. I did well this year in the market. It wasn't my best year ever, like a lot of people, but I used one piece of evidence, which I thought was a big piece of evidence, right? The housing market. I used that to say underweight the market probably a little bit longer than I should have. And I don't mean underweight. I mean underweight just in terms of I didn't have enough risk, in my opinion, still 100% equities, but just didn't have enough risk. Like I wasn't risk on enough because I saw one area of the market kind of failing. And that area of the market was home builders and home construction. What did they end up doing? They ended up rallying, and then I added my positioning here and I actually caught some of the bottom in home builders. But the lesson was, when you look at the market from a weighted the evidence approach, you don't take one piece of evidence not weighing in and then underweight your positioning because of that. And that's what I did. I allowed, 8 out of 10 things to be bullish. And because of that, I stayed 80% long. When 8 out of 10 being bullish, I should have stayed 100% long. I know that's a little nuanced, but that was the lesson for me this year, and seeing some bearish evidence. I think in the past, when I saw some bearish evidence, I automatically took some positioning off. And that's just something I have to learn, is you don't have to take some positioning off because there's some bearish evidence. The bull market does solve those problems. I'm not saying I was bearish. I'm saying I allowed one piece of evidence to lower my positioning when I shouldn't have, because the weight of the evidence was still bullish. So that was another lesson for me this year, is I did good work when it came to the home builders, and we made money on the upside with the home builders and actually ended up making money on the downside too with them. But I allowed one area of the market to really determine my positioning, which I shouldn't have. And then the next thing I wanted to talk about here was IGV SMA. So this was probably my worst call of the year. And this one, it just kind of makes me laugh because it was such a bad call. But I wrote an article about software versus semiconductors, and I thought software was taking the reins from semis. And I laugh now because this is the updated chart. So as you can see, the thesis of software is taking over semiconductors was failed one. That did not happen this year. We did get this base breakout, and it did go for a little bit, but it eventually failed. And now, right, software is getting beaten up by semis. Semis are trading at all-time highs relative to software, at least on this chart, right? So multi-year highs. And there wasn't really this one, to be honest, there wasn't really a lesson in this because it's not like I went overweight software relative to semis. It was more of a market regime trying to understand how the market's evolving perspective. And actually, you guys can kind of look at some of my work, but I've kind of been more bearish towards software because of this as of recently. I've kind of used software to hedge some of my technology exposure. So the lesson in this was just like, you can laugh at yourself. You're going to make mistakes. This is one that I thought the thesis was sound. We did have the failed. And I think the lesson in this is like, doesn't matter how clean the chart is. Just because the chart is super clean doesn't mean the trade's going to work. I think we have technical analysis is complicated because you have infinite charts to look at. And when you get a textbook, it'll show you a picturesque clean uptrend and it'll show you a picturesque breakout. But there's a lot of clean looking charts that fail to break out. And so once again, that gets back to that you can always get back in. Understand that when you're in a trend following system, there's going to be a lot more failures than say mean reversion. So you're going to have a lower hit rate. But when you hit, you're going to have a larger expected value of winning in that win. So that's just kind of the thing you have to understand is like when you're in the trend following, you're going to fail a decent amount, but that's okay because the wins tend to add up over time. So this is just one that I got wrong. Semis versus software, not a great trade on my part. It happens. I had a decent thesis, I thought, but that kind of failed. So those were kind of the lessons this year, guys. I actually got a lot more trades wrong, right? But the lessons are we're in the business of making mistakes. You're going to make mistakes. Going into 2026, one of the things I want to do is not only be transparent about mistakes, but just be willing to make them. Because if you manage risk properly, you should be willing to make mistakes. I think I'm still struggling with this just as a human of putting not all my eggs in one basket, but swinging the bat and then holding on really, really tight to see where the ball goes instead of just swinging the bat and getting back in my batter's stance. So that's one of the things this year I want to get better at is just getting back in my batter's stance, waiting for that next pitch, versus sitting in something like that bond trade I sat in for way too long. And kind of just allowing that to kind of consume my brain for too long of the year because it's something I didn't need to spend that much time thinking about, the ramifications of the bond market. It wasn't something that really needed to impact me. And same thing, the ramifications of housing, right? Housing went down. So be where your feet are, right? Be where the trades are that are in front of you. David Lundgren, very well-known CMT market technician, talks a lot about that. And his work is like, if stocks are going up and stocks are going down, right? Buy the stocks that are going up, short the ones that are going down. And I think when I do market regime analysis, which keeps me on the right side of the market the majority of the time, I can become one focus. Like I'm only long, I'm only looking for longs. And I try to get too creative with my longs when it's like this one area of the market isn't working. It's not that big of a deal that it's not working. So that was my takeaway for the year, guys. Right? It's a mistake business. You can always get back into your trades. Stop trying to be overly unique. And then the last lesson, which Gene, you can just kind of put this on me because I didn't write about it, is the last lesson here is omission, right? So in everything I share, I can only share the mistakes I made in terms of like trades I took. It's hard to, and this is a reflection I encourage you guys to do, it's hard to look at the trades you didn't take that you should have taken, or the areas of the market where you got out too early, even though it was a winning trade. So those are the caveats here. There's probably plenty of trades that I probably got out a little too early and should have stayed in. Or there's areas of the markets I didn't have enough exposure to, like commodities. I didn't have enough exposure to palladium and aluminum, and I don't have a ton of exposure to copper, and I really didn't have a ton of exposure to silver. I had a good amount of exposure to gold, but that's something that is missing in when when you're not looking at what you didn't do, right? It's hard to kind of choreograph everything that you didn't do, but there's some trades I didn't take. So those were kind of my lessons for the year, guys. I hope you guys have some good lessons from the year. Leave a comment maybe about some of the lessons that you learned or any lessons that you're trying to overcome. Maybe I can give some insight to those. But I did want to take the last 10 minutes of the show to kind of look at a couple charts. Gene, I'm going to pull up just the software here. Kind of look at a couple charts from last time. People left some comments about some charts, so I just wanted to go through those quickly. First chart was Coreweave. There's a comment about Coreweave, right? In general, I don't get too excited about something like this, but let's take a quick look. The thing I'm going to do here, and something that doesn't have a long history, is a lot of times I just run an anchored VWAP from the beginning of the chart. Right, so IPO anchored a VWAP, and then a lot of times I'll run like an all-time high one. So if we plot both of those on this chart, do that quickly. An all-time high. All right, you can kind of see around this $100 mark is where you're going to start running into some battles. But short term, you do have this little base building. All right, kind of see it here. Kind of have a little bit of a base building that's taking place. So against that $75 area, if that's something you like, that's where you can probably manage risk against. Is that 75? This scoop and score type pattern isn't something I do a ton of trading on, but this is kind of how I would look at it. And then when it kind of gets to this $100 area, I think it could struggle. But if you like it, I would kind of manage that risk against this low a couple days ago, maybe $70, and then kind of see what the upside looks like in something like Coreweave. But overall, I'm not a huge fan of software at the moment. I think some of the software charts don't look that great. I'll pull one up real quick. I think semis is still the place to be. Continue without saving. So software as a whole right now, not my favorite area of the market, which we kind of just talked about. So this has kind of been my hedge, which if you watch some of my previous videos, I've kind of highlighted. I've hedged some of my tech long with software short. So don't really love the looks of Coreweave as a whole or software as a whole right now. It's just not the area of the market. This isn't my type of trade. There's some individual names that look good, but even seeing what's the one I was looking at today? CrowdStrike. The way CrowdStrike looks in the software space, just right. You kind of had this failed breakout in CrowdStrike, and now it's kind of failing at its 200-day. Not something I love overall. So Coreweave, I'd say it's mixed at best. If you like it, kind of against that 70, 75 area. So the next one was BMNR, which I think one of the lessons, this was the lesson I learned early in my career. You don't have to have an opinion on every single stock, and you don't have to trade everything that's trading just because there's big ideas or big movement in it. And BMNR is one of those names. So I would just say my opinion is that I don't have one. This area of the market is just riddled with news and drawdowns and volatility that I just don't position myself in. So that's what I encourage, is like, you don't have to have an opinion on everything. Find kind of how you like to trade, the setups you like to trade, the style of trading you understand, whether that's trend following, mean reversion, breakout is a form of trend following. Kind of align yourself with that, find its weaknesses, find its strengths, and then understand that as you kind of trade throughout that. But BMNR, I don't have a strong opinion on as a whole. It just kind of looks like a choppy mess, right? RSI kind of in no man's land, just choppy mess in my opinion. Next one people want to take a look at was First Solar. Okay, so let's zoom out on something like First Solar, because I believe the zoomed out chart actually looks pretty decent. So let's do a weekly chart. Yeah, so seeing like something like the weekly chart. So if you have that longer time frame, the weekly chart in First Solar looks pretty good. Make sure I have dividend adjusted. Yeah, so First Solar, good chart. Shout out to the chat for something like First Solar. You have this base. You guys can see it. I don't really need to draw it, but I'll draw it. All right, you kind of have this base in First Solar. All right, and then you kind of have this lower level, which, right, prior cycle high from that higher lower high, sorry. You kind of have this consolidation here. So it looks pretty decent. Let's zoom into the daily. Yeah, I don't hate the look. I like the looks of First Solar here. So if you remove this, you can kind of see here, you have a little bit of a you have a little bit of a base forming, right? Kind of see this base. So kind of like this setup overall. You can see RSI staying above 50 this entire time. Just a clean uptrend. Consolidation probably resumes higher. So First Solar, good looking name. Good looking chart. Pepsi was the next name. I got like 4 more here. Yeah, like I don't know what to tell you about Pepsi. I know this was from 2 weeks ago. So 2 weeks since then, Pepsi's really kind of broken down. So not my type of trade on the daily. I don't really see a setup here in something like Pepsi. We can look at the weekly. Yeah, don't love the looks of this, right? So I see a chart like this, I just move on. I don't see a setup, right? 3 weeks down in a row, not something pretty here. Let's look at Coke. Somebody's curious about the sodas, huh? Once again, I don't love the looks of this. Like it's just consolidating sideways, kind of range bounds. I don't know if there's any money to be made here. There's a lot cleaner, nicer looking charts in this space as a whole, but let's just kind of run through them. Celsius, not great. MNSTR, Monster, or what is Monster now? MNST, sorry. Yeah, I mean, yeah, I don't really see a current setup in any of these names. UPS was the next one. Okay. UPS is trying to turn it around. If you kind of zoom out, probably a monthly even, you could see UPS is finding support where it used to have, right? Prior support area around this $90, $100 mark. Zooming in, if you're a little bit more of a tactical, you could see a base forming here, right? You kind of see this base playing out, which not that hard to see. So what you get above 102, you actually probably have that breakout to the upside. I don't hate the looks of this. You could use, right, this 98, use today's low or this pivot here. So this is the pivot high. So that $98 range, you kind of have this falling wedge trying to break out to the upside. So something like UPS looks pretty solid. If you're looking to maybe diversify into something that's not currently in a long term, like in a intermediate term uptrend, is trying to form an uptrend, I don't hate the looks of UPS. And then 2 more here for us, VIAV. Just consolidating, right? Kind of a broadening pattern in a consolidation on the daily. It's, I mean, long-term chart, right? It's strong uptrend, kind of breaking out here. So we break out above these all-time highs, right? Just off to the races. So if you already have a position in this, you can probably keep going, but it's kind of overheated. So I think continue to consolidate here, but above 1750, you're pretty good in a name like this. Last one, Zscaler. Yeah, once again, this is software space, right? Software doesn't look good as a whole right now. There's not a ton of charts in there that I like. Like I said, CrowdStrike to me is like the name to own, and it's breaking down with CRM, right? Kind of tough week this week. So I just think software as a whole needs to get off the mat. Right. Right. This is software as a whole. Kind of struggle bussing. Below overhead supply. Don't really like it. I like the semis though. Right? Why are we so focused on software? You guys sound like me last year. Why aren't we giving the time of day to the semis? I just had this chart, just shared this chart on Twitter a little bit ago. Semis are breaking out. I think we should be looking at a little more semi charts, a little less software. But that's what I had, guys. Thanks for sharing the charts. Leave a like or a comment. Like I talked about, these are kind of some of my lessons. And then I just wanted to pop through a couple charts that people shared over the past couple weeks. I hope we have a great weekend and we'll be cranking through it in 2026. So let's go, guys. Happy New Year. Love you all. Have a great night. Cheers.